All right. So there's something at Sivers that's not adding up. If you're a bear, the argument is simple. Show me the revenue. In Q1 of 2026, Sivers generated 61.9 million Swedish kroner in revenue, down roughly 22% year over year. Adjusted EBITDA was negative 13.8 SEK. Operating cash flow was negative, and some revenue expected in the first half is now moved into the second half of 2026. Those are legitimate concerns. But here's the other side. At the end of 2025, Sivers reported an opportunity pipeline of approximately $453 million. And by Q1 of 2026, that rose to $799 million. And that's approximately 77% growth year to date. And surrounding that pipeline are names like Global Foundries and Jabil, Ayer Labs, ONET, and Enemblance, Allspace, and now SemiNex. So we have two completely different pictures of the same company. Today, relatively, the company has small revenue, has losses, and it has delayed programs. But tomorrow, a nearly $800 million pipeline and multiple potential production ramps, that's the tension behind this entire video. I'm invested in Sivers, but being invested does not mean defending everything the company has done so far. It means asking one question. Is my investment thesis getting stronger or is it getting weaker? And starting with this video, I'm going to measure that with a Sivers Thesis scorecard. But before we get excited about what's coming, we need to deal with what's happening right now. And that starts with the bad news. So this week, Sivers announced an expected $42.9 million SEK related to Social Security contributions associated with its employee incentive programs. That sounds terrible, but there's important context. During quarter two, Sivers' share price went from approximately 10.71 SEK to 63.15 SEK. And that increase raised the accounting liability associated with those incentive programs. According to Sivers, the 42.9 million SEK charge, or 4.29 million in US dollars, is non-cash and doesn't affect the underlying operating performance of the business. So that's not what concerns me the most. This is revenue expected in H1 has moved into H2. We've heard that explanation before. Management policy cited delays involving U.S. government and defense budget approvals. I can accept timely differences in defense, SATCOM, and complex semiconductor programs, but eventually timing has to become revenue. And if revenue expected in Q1 moves to Q2 and then H2 and eventually into 2027, we're no longer talking about timing. We're talking about execution. And that's why August 27th, when Sivers reports Q2 earnings, it matters. So I want to know whether management still expects those delays revenues in H2 and whether the full year growth plan remains intact. So my verdict on this week's bad news is simple. 42.9 million SEK or 4.29 million in US dollars. Is it mostly noise, revenue delay, or is it not noise? And that takes us directly to the bigger number in the Sivers thesis, which is 799 million US dollars. At the end of 2025, Sivers opportunity pipeline stood at approximately $453 million. And by Q1, that rose to $799 million of Q1 2026, which is up 77% year to date. And according to Sivers, that growth came from a higher production forecast on existing opportunities and increased customer interest in products, including wireless beamformers and NP lasers. The company also said customer interest in pluggable optics increased following its Jabil collaboration. But we need to be extremely clear. 799 million is not revenue. It's not backlog. It's not 799 million of signed purchase orders. Customers can change plans and programs can be delayed. Qualifications can fail and competitors can win. So I'm not putting $799 million into a revenue model. Instead, I'm asking how much of that would actually convert to matter. Just to understand the case, 5% equals $40 million, 10% equals $80 million, 20% equals $160 million, and 30% equals $240 million. And those are not forecasts, they're scenarios. And that's the important realization. Sivers does not need all $700 million to convert. It needs enough of it to convert to materially change a company that generates $304.1 million in revenue, SEK, in all of 2025. And that's $30 million US dollars. So that's why 2027 matters so much. 2025 and 2026 have largely been about building products, partnerships, customer relationships, and the pipeline. 2027 needs to be about conversion, pipeline, qualification, design wins, production, and revenue. So the question is obvious. Is anything actually converting into actual revenue? Now, this is where All Space matters. In June, All Space placed an actual $8.2 million production order with Sivers for Ka band beamforming IC supporting volume production through 2027. That's different from an opportunity. They ordered the product. Sivers described that relationship as progressing from development to initial production and towards scaled multi-year development. And towards scaled multi-year development. And there are other wireless programs moving as well. Sivers says its 28 gigahertz production ramp with SATCOM Networks is underway, while here's SATCOM Networks 28 gigahertz production ramp, while Tier 1 telecom vendor is targeting its first fixed wireless access products by the end of 2026. And then there's the photonics stage, photonics. A strategic LiDAR customer is expected to begin ramping production in Q4 of 2026. Sivers will supply lasers and optical amplifiers, and the company has disclosed potential lifecycle revenue of $53 million to $138 million. Again, that's potential revenue, and that's not a $138 million order, but it's movement down the funnel. And that's how I want to judge future Sivers announcements. A partnership is interesting. Sampling is better. Qualification is better than sampling. And a design win is better than qualification. Production order is better than a design win. And revenue is the scoreboard. So the bull case shouldn't simply be look at the $799 million pipeline. It should be look at how much of that pipeline is moving towards production. To understand that, why that pipeline could become so large, we have to leave Sivers for a moment and look at what's happening inside the AI factory. AI infrastructure has spent years focusing on compute, GPUs, HBMs, advanced packaging, power, cooling. But more compute creates another problem. The data has to move. AI clusters are getting larger, and networking is moving from 800G to 1.6 terabit to 3.2 terabit eventually. And as those speeds and distances increase, electrical and connectivity increasingly runs into challenges involving signal loss and power and heat. And that's why optical connectivity becomes increasingly important. The equation is pretty simple. More GPUs equals more data equals more bandwidth equals more optical links, which equals more lasers, which is great for Sivers. And we're seeing an evidence of that across the industry. Coherent has talked about strong AI data center demand and expanding capacity. And meanwhile, Sivers is already targeting 1.6 terabit pluggable optics through its Jabil collaboration. And that's important because sometimes the Sivers thesis gets reduced to one acronym, and that's CPO. But Sivers isn't waiting for CPO or co-packaged optics, and that's one of the most important parts of this investment thesis. So right now, AI data centers still rely heavily on pluggable optical transceivers. 800G is here, 1.6 terabit is beginning to commercialize, and Sivers is already targeting that market through Jabil's 1.6 terabit LRO pluggable using Sivers DFB lasers. so Sivers does not have to wait for CPO. Longer term, the industry is exploring architectures that bring optics increasingly close to the compute, which is LPO and NPO and CPO, and external light sources. And that's where Sivers multi-wavelength lasers array could become increasingly important. And Global Foundries makes this especially interesting. Its collaboration with Sivers isn't limited to CPO. It specifically includes CPO, LPO, and other emerging data center interconnect architectures. And that's why my thesis is not CPO has to win. It's Sivers does not need CPO to win. It needs optics to win. If pluggables last longer than opportunity, and if LPO grows, there's an opportunity. And if CPO ramps, there's also an opportunity. If external light sources become critical, and there's another opportunity. None of those guarantees that Sivers wins, but strategically, I like that Sivers isn't making one binary bet on one architecture. And when we look at the companies surrounding Sivers, that positioning becomes even more interesting. By the way, go to AI Factory series seasons 1 if you want to learn about fiber optics and speeds of 800G, 1.6 terabit, and so on. Same thing with co-packaged optics, CPO, and how it affects the compute versus a pluggable transceiver. So instead of looking at every Sivers press release separately, put the partners on one screen. First, you got Global Foundries. Sivers lasers arrays integrated with silicon photonics scale optical engines. Next is Jabil, 1.6 terabit LRO pluggables using Sivers DFB lasers. Next is AR Labs. Years of work around CW, WDM laser arrays and optical IOs. ONET and Enimblance. ONET and Enimblance. ONET. An external light source architecture combining Sivers lasers with optical coupling and module integration. Next is POET, sampling Sivers DFB lasers for an optical engine product. And now you got SemiNex. SemiNex is here. At some point, you have to ask, why are this many serious companies working with Sivers? As Sivers is tiny compared with many of them. And these companies have options. They don't prove Sivers has an unbeatable moat. Coherent and Lumentum are enormous competitors, but Sivers doesn't need to dominate the entire laser industry. It may only need to become an important laser supplier inside certain high growth architectures. And that's why I think the pattern matters more than only one partnership, as this is beginning to look like an ecosystem. And the newest SemiNex deal may tell us where that ecosystem is headed next. Now, when I first saw the SemiNex announcement, I had a question. Why does Sivers need SemiNex? Sivers already makes NP lasers, DFBs, multi-wavelength arrays, CWWM. So why partner with another NP laser company? And I think the answer is Sivers brings precision. SemiNex brings power. Sivers has expertise in multi-wavelength DFB arrays, wafer scale manufacturing, and optical architectures. And SemiNex specializes in high power DFBs, high power SOAs, and MP epitaxy. And the problem they're attacking is exactly where AI networking appears to be heading, which is more wavelengths, more optical power, higher efficiency. And as optical systems scale, simply driving today's lasers creates challenges involving heat, efficiency, and reliability. And one potential solution is combining multi-wavelength laser arrays with high power amplification. Simplified, Sivers DFB array, SemiNex high power SOA technology, and then you have next generation external light source. So let's go through that again. More wavelengths equals more power, and higher efficiency equals next generation external light source. Sivers and SemiNex are you have precision and power. And the initial program is worth approximately $3.4 million. But the number is not the most important part. The target is customer sampling and early production ramps into H2 2027. There's that year again, 2027. All that space, LiDAR, FWA, potential pluggable production, laser qualifications, and now next generation external light sources. And that's exciting, but it also gives management a lot to prove. If we're sitting here in late 2027 still talking about sampling, partnerships, and potential, then the thesis weakens dramatically, and also the stock price. If we're talking about product shipping, then Sivers becomes a very different company, and that brings us to valuation. So, what would a Sivers 10x require? Sivers is trading around $4.46 today. Yesterday it was around $4.19. 10x would put the stock around $42 or $44. And that's an enormous move. And Sivers isn't going to earn it simply because AI grows or because the company has a $799 million pipeline. A 10x has to be earned. I see four broad outcomes. First, you got failure. Pipeline grows, partnerships continue, but production does not arrive. Revenue remains small, and cash burn continues. The dilution continues and the thesis breaks. Next is modest success. All that space, LiDAR, and some wireless programs ramp. Maybe one or two photonics customers enter production, and Sivers becomes a larger company, but not necessarily a 10x company. Next, you got strong success. Several programs ramp simultaneously, pluggable customers move into production, and the AI optical programs become meaningful. Revenue grows dramatically, and Sivers moves towards sustainable profitability. Now the valuation can change substantially. Then you got the 10x case. For that, I think Sivers needs to become an important supplier across several large markets. AI data center lasers, pluggable optics, external light sources, LiDAR, SATCOM, defense, fixed wireless. And we also have to watch dilution. Sivers had roughly 320 million total shares by mid-May, and it raised additional capital. If more shares are issued, the market capitalization required to reach $20, $40, or even $50 a share increases. So I'm not giving Sivers a $42 price target. I'm saying that's the level of business execution a 10x would require. Revenue, margins, cash flow, controlled dilution, and multiple successful production ramps. So now let's score what that thesis stands today. So this is my first Sivers Thesis scorecard. AI demand, green, is very strong. Technology, green, strong. Partnerships in the ecosystem, green, strong. $799 million pipeline, again, it's strong, but still only potential. Design wins, order is yellow and it's developing. Production is developing. Multiple ramps are approaching. The revenue growth is a yellow and it must improve. Profitability is red. It's not there yet. Balance sheet and dilution is yellow and to watch. And execution is yellow. And this is the big test. Put it together. And my first Sivers scorecard thesis is a 7.4 out of 10. And the status is it's intact, but it must convert into revenue. And the next checkpoint is going to be August 27, 2026 for Q2 earnings. I'm watching 6 things: revenue, full year growth, pipeline, AI photonics, production ramps, and cash. And that's it. Those are the things that can move this score, because the bears and bulls are looking at two different Sivers. The bears see today as small revenue. You have losses. You got a lot of cash burn. You got delays and dilution of shares. And the bulls see tomorrow $799 million pipeline. The AI photonics, global foundries, Jabil, all that space, LiDAR, SemiNex, and multiple 2027 ramps. Both sides have evidence. The question is what happens between those two worlds. And there's one word that connects them, and that's conversion into revenue. Pipeline has to become design wins. Design wins have to become production. Production has to become revenue. And revenue eventually has to become profit. Sivers doesn't need all $799 million to convert, but it has to convert something. And eventually it has to show up as revenue. The technology got them here, and the partnerships got them here. The pipeline got them here. But from this point forward, Conversion determines what happens next. All right, so here is Sivers as of today, August 14th. They're at $4.42. It's up 6.33%. Well, now it's at 440 and 5.77% for today. It opened at 430. The high today was 449. The shares outstanding is 331 and number of employees is 132. Sivers Semiconductors AB surged over the past month due to robust operational programs and strategic AI partnerships. Analysts project strong revenue acceleration in the second half 2026, driven by deferred H1 revenue catching up and realization of massive product pipeline, despite short-term headwinds from deferred recognition. The Bullish expanding AI data center pipeline. The company has announced approximately $3.4 million program with SemiNex to develop next generation indium phosphide light sources aimed at powering AI data centers. Additionally, the company's multi-year sales and opportunity pipeline expands significantly by approximately 77% to $799 million. Then you got strategic partnerships, global deals, collaborations with major industry players like global foundries and to build for AI infrastructure, alongside massive production orders such as $8 million contract from All.Dot Space for the Ka-band beamforming chips, highlight the business transitioning scale towards commercial maturity. Maintain 2026 growth projections. Management has reconfirmed its full-year guidance, reassuring investors first half revenue delayed by U.S. government defense budget approvals will be fully recognized in the second half. Balance sheet liquidity remains well-funded following institutional cash injections and recent warrant exercises. The bearish non-cash social tax liability charges. Monumental rise in the company's share price from approximately SEK 10 to SEK 6.3. So that's basically $1 US to $6.3 US. Forced management to establish a non-cash social security accounting charge of approximately 4.2 million US dollars for the second quarter, impacting short-term reported net income. H1 revenue deferrals from budget delays. First half financial results suffered operational impacts. Year-over-year revenue declined due to U.S. federal budget approval delays and subsequent defense spending bottlenecks, making the company temporarily dependent on smooth execution in the back half of the year. High valuation hype and capital dilution. Sivers continues to trade under high valuation multiples driven by short bets and speculative AI interest. The company has also historically relied on dilutive capital allocation strategies, including recent directed share issues and convertible loan financing to sustain heavy burn cash. So those are the bears. All right, thanks for watching. If you enjoyed this Sivers Thesis update, make sure you like the video and subscribe to 20 Minute Stock Hunt so you can follow along and see where we track whether this pipeline actually converts or not, and follow Season 2 in the AI Factory. If you want the additional research and notes behind the companies and technologies that we're following, you can join the AI Factory membership at buymeacoffee.com. Link is here. Also, the link is in the description. Thanks again for watching, and we'll see you in the next 20 Minute Stock Hunt video.